All right. And once I get my mic level back to a good spot, we're going to go full screen webcam. There we go. Welcome back to another weekly, albeit one day delayed due to Easter, weekly stock market scan. I finally figured out how to get my webcam to show up widescreen so we don't have the big black bars on the side anymore. You now have a really nice view into the other side of my bed now and the other side of my doorway. So really moving up so far in the streaming quality world. Petty Bourgeois, Jules, what's going on? Thanks for tuning in. Thanks for checking into the chat. Yeah, the black bars are gone. So great technical achievement for us right there. We're going to try to really up the production quality of these things moving forward. And that was step one. So with that said, Monday is already in the books, right? We've got 4 days left in the market. And luckily, since we delayed our stream a day, nothing really happened today, so it's going to be a great way to sit back, CPIs on Wednesday morning, discuss one, what happened today, which there wasn't much of, and two, have some nice fresh ideas and a game plan for how we're going to react to when that event does come on Wednesday morning. So without further ado, and to avoid just, making this a nice little monologue for you guys, although I guess technically it is a monologue every single week, we're going to go back to the main presentation. Gentle reminder, if we ever get up to 30 live viewers, we are going to have a giveaway like we used to have. And these are going to be, actually, let's go back to the full screen. There we go. This is what we will be giving away, the HT Yeti mug. We've got several of these. We just don't have 30 live viewers yet. So maybe shooting ourselves in the foot a little bit here by streaming on a Monday instead of the typical time. But if we do get there, one of those is going out the door to you guys. So back to the presentation. There you go, at the bottom of the screen right over there. Look at that. Nice little interactive stream going for us right here. If we get to 30, it's happening. But hasn't happened yet. Let's go down, talk about last week, and get back into the swing of things here. So last week was a good week for us. We made $790, which, in a vacuum, 790 bucks, kind of whatever, right? But the bigger picture, the bigger purpose here is the fact that both the S&P 500, albeit by a small amount, and Nasdaq were red on the week. So S&P 500 dropped 0.05% and Nasdaq dropped 1.1%. And with that, we were still able to return 0.42%. So respectively, we outperformed the S&P 500 and Nasdaq by 0.47 and 1.51%, thus moving us towards our ultimate goal of long-term outperformance in the market. So good, we did a good job there. And let's talk maybe quickly top to bottom, because while we did have a lot of trades, I think there's a lot of rows for like just some individual trades. And I'll zoom in here a little bit. I'm doing you guys no good being that far zoomed out. We've got a comment asking if the stream quality is a little lower because Twitch won't let you increase it over 720. Guess we're already having some technical issues. If that keeps up or anyone else is having that issue, let me know. We'll see what I can do to fix it. I may have messed up some settings trying to get everything else figured out. Like our little countdown video. Check that out. Nice little thing, huh? It's almost like a real show now. If I didn't have my bed in my background. But other than that, small steps. Top to bottom, Affirm is a great example we talk about when we want to start with a half-size position into a trade. Why do we want to do that? We want to do that because of exactly what we saw happen last week with Affirm. I think it'd be helpful if we pulled this chart up really quickly, go to the old 5-day chart. You're going to be missing Monday here. Actually, no, you're not. That's not true. Here is Monday, and as you can see on Tuesday, Affirm went from 1141 down to 1070. And the position that we had was that 11 strike put. So, oh no, our 11 strike was breached. But that's okay, right? Because we have, yes, an 11 strike where we would have hit max profit, but we had a break even of 1049, which is that 11 strike minus the 51 cents of premium, of course. And eventually that got breached as well. It was sitting right here. So when this gets breached, not a problem in the world, right? Because we know that as long as it stays above this second red line, our break-even price, we're going to make money. And there's really not a ton to worry about in that regard. But on Wednesday, when it did break below that, important thing first off is when it breaks below it immediately, we don't want to do anything because it could quickly bounce back up and it won't be a problem anymore. Or two, it could get worse, in which case doubling down would be an even bigger problem for us. But as it moved towards 10 late in the morning on Wednesday, that was when we decided to double down. So this is a great example of how effective that can be. So our original trade, right, was a 51-cent premium. We sold 5 of them. It was going to be at about a $250 profit, which we would have gotten above 11. But when we scaled in with the 10 strike put for 23 cents a premium, that was a cent for cent reduction of our break-even price. So it took our break-even down to 10.26, as we can see over here. And 10.26 looks like this on the chart. So while it didn't quite cover the bottom of that move, you have to understand that in such a short time frame, that 4-day time frame that this trade was playing out during, having a max profit point here, which is already below where it started at, having an initial break-even price here, which is decently below where it started at, and then eventually legging into part 2 of that trade and getting our ultimate break-even price down here is very flexible on a week-to-week basis. And again, as we all know, if shit hits the fan and it keeps going down, all we get are shares at a basis. We sell covered calls. We move the red lines lower for the following week, and we just keep the line moving. But we got to see the benefit of what happens when we run trades like this, because it bounced back up above that red line, and we had a trade where the stock objectively, well, at the end of the day, I take that back. This is today, Monday. So at the end of the week, it was sitting at about 10.58-ish. So before, that was kind of right around our break-even price, but thanks to the fact that we had this initial trade where it did make $70 for us, but then we used that cash we had on the sidelines to add more with the 10 strike put, we actually made a profit of 185, despite the fact that the stock went from a little bit above 11 down to 1060 by the end of the week. So it was generally red on the week, yet we made money, and that is thanks mainly in part to starting with the half size position and scaling in. Peloton, that was a much easier one where 11 really never got threatened during the week, so we didn't have to do that. Again, we always talk a little bit more about the losers here because there's definitely, not the losers, but the more difficult trades, so to speak. There really weren't a lot of losers. SPXU was our hedge, and we've kept that XPSU. UVXY as well, those are both hedges. SPXU is inverse of the S&P 500, and UVXY is long volatility. Volatility typically spikes up when the market comes down. So both of those we had on as hedges. And since the market was red, and it really wasn't even that red, but since it was a little bit red, our SPXU trade pulled us $290, and I think UVXY broke even. Yeah, so on those hedges, even though we didn't really have anything too crazy from a downside perspective, it still gave us $290 since the market did not move in our favor. Next one we'll talk about is DPST. We really liked that one because it was trading, I think, high sevens when we were first looking at getting into it. And what's happening with this is it's the regional bank ETF, so we could take a look at it and kind of see a little bit of how it performed last week, what it did today. And there you have it. Spoiler alert, it definitely moved against us a good bit, which is why you see 2 lines for DPST on the chart there. But we like the idea behind this one because regional banks are pretty beat up. Everyone knows that. There's decent volatility, and with decent volatility comes a really nice option premium that we have decided we're going to try to sell. Now, the issue, if you want to go with like a WAL or an FRC, is those individual regional banks carry a risk where, overnight they could, fold, while a lot of the momentum against banks is kind of held off for a little bit. That's definitely a possibility that we want to keep in mind. So investing in something like DPST, which is that regional bull ETF, gives us a little bit more flexibility in the sense that there's no isolated bank risk, right? You could have one bank out of 20, and then for whatever reason, that one bank, kind of shits the bed and goes under, and you just get unlucky. You take that scenario out of the equation when you invest in a more diversified ETF like this one. And that's not to say it can't be volatile, but I think what we do avoid here is that zero scenario like we saw with SIVB, where that thing, I don't even know if the chart's going to load because it went bankrupt. SIVBQ, there you go. 60 cents a share now. I don't know if you'll be able to see the activity before. You won't. But yeah, we want to avoid holding something like this, and DPST gives us that benefit. But with that said, we started with a 7.5 strike put, and if we go back to the 5-day chart here, we take all these lines off. Let's remove the old drawings, yada, yada, yada. So we know that with our 7.5 strike put, we sold it for 30 cents, so our initial break-even price was going to be 7.20. And we did this when DPST was right up around here. This was that Monday, or excuse me, was it Monday or Tuesday? I'm going to check so I don't sound like an idiot here. It was that Monday. So Monday, April the 3rd, this is what we were looking at. Friday was what was closed. That's right. It was a 4-day week with the back end being closed down. So this is what we were looking at Monday. And we got in right about here. And this is probably on this 5-day chart the absolute worst place that you could have gotten into DPST. Yet despite that, and how rapidly it moved against us, we're actually okay on DPST, but let's walk through the trade, right? We started with those 7.5 strike puts. We sold those for 30 cents. That took our break-even price to 720, right? The 7.5 strike price minus the 30-cent premium we received, 720. That's that red line right here. Now, of course, we see that it broke below that on Tuesday morning. And again, similar with the firm, right? We remember with the firm, when it breaks below that red line, don't react right off the bat because it could either go back up or get worse. And if it gets worse, you're going to regret scaling in. But it did get worse very quickly. It got down to the 670-ish level. So we said, okay, now we're going to take that cash that we saved on the sidelines and scale it into the trade. So our break even goes from 720 right here. And then we sell the 6.5 strike puts for 21 cents a premium. And again, we started with 5 contracts. We add 5 contracts. That's a double down, meaning that this premium we receive is a cent for cent reduction in our break-even price. So as you can see out here, our break-even price got down to $6.99. So with that second trade we added, boom, the red line moves down here. Now on Tuesday and all of Wednesday, the stock was trading below that. And sometimes that's just going to happen. Unless you really, really want to get crazy in week 1 of a trade, you don't need to try to do anything crazy and be a hero and play catch up, because a lot of the time, the market goes up, the market goes down. And as you could see, we were patient on Friday. It popped back up above that break even price. Now, we had rolled the position early in the morning off this big green candle, just, to take advantage of the jump that we saw on Friday and not get greedy. But all in all, despite the fact, at how sharply, steeply, whatever S adverb I want to use, how sharply, I'll go with that one. That this stock fell from our entry point here on Monday morning, and the fact that it finished at 7, we started this thing almost at 8. That's a drop of like 15-ish%, I believe, on a weekly basis. We only lost $35 on the trade, and the great part about these things is while we sell options that have set expiries, we can roll those week over week over week. And that's exactly what we did. We rolled the half size position again. We had the benefit of being able to do that. 7 strike. Again, we started with the 7.5 with 5. Now we're down to 7 strike with 5. So we have the half size position, even better strike. And we're in position to make $265 on that this week, so long as it finishes above 7, this red line. So we've got 4 days left in the week, but that $265 potential profit we're looking at this week combined with this means that we'll get a combined profit of $230 on a roughly 2-week basis, just so long as this stock stays above 7. And again, that's the great part about this, right? We started this at almost $8 a share. We don't need the stock to do anything crazy. We don't need it to run back up to 8, 9, 10. We don't even need it to go back to where we started. It could finish 15% down on like a 10-day basis, and we're still going to take home some cash. And the great part about this roll is that all we need to do to break even on the trade, right? If we remember last week, I think I scrolled too far. Last week we lost $35. In order to make back $35 on this trade, I think all we need is DPST to be at like 6.52, is that right? 6.54. Boom. So we only needed to go to 6.54 to make $35 of profit, meaning that our red line is now down at 6.54 all the way down here. And that is with keeping the half size position. So again, not to sound like a broken record, but remembering that we had that half size position and doubled down to lower it further. We're in that half size position. The red line's already been lowered down here, and we have the flexibility to double down further in case it does continue to fall that far. So with DPST, I think we're in a really, really great situation right now. And even though this trade took a couple of weeks and lost us a tiny, tiny bit of cash last week, really good example of how when you've got volatility on something like that combined with a low RSI, you have a stock that theoretically could be finding a bit of support, how flexible those break-even prices can be on a really short time frame. So that was DPST. AMC, this was a great one. This was one of our IV reversion type trades, I believe. We go to AMC. Boom, you see this big red candle. Now, typically with the IV reversion, it's on good news, but every now and then you could get away with playing bad news, a big red candle. That's exactly what we did. There was news that APE, the preferred shares of AMC, had come to an agreement where they could effectively be redeemed for AMC shares. And for AMC shareholders, we could show you APE. That's good news for APE, right? Because now it becomes part of AMC. But for AMC shareholders, it's bad news because it results in dilution of the stock. Now, a little bit later in the week, a headline came out that said, well, not so fast. They're not quite at an agreement yet, so it recovered. But The great part about what we were able to do with this big drop, you'll see a big spike in implied volatility, right? This is what we look for in these IV implied volatility reversion trades. A big spike in blue, which we are comfortable and confident that will eventually settle back down. This pumps option premium into the options. We sell high. The drop in IV takes the premium out of those options, and we buy back low. The perfect in and out from an option selling perspective. Now, with that said, we sold the 3.5 strike puts for 11 cents. We did that because we saw by the time that the market opened on Tuesday after that news had dropped, it had got back up to 4. We saw the pre-market low was 364. So just to be safe, quote unquote, you can never be too safe with some of these meme stocks, I know. But just to be safe, quote unquote, we sold the 3.5 strike because that was a level that just had not been hit in recent memory. So we were able to get 11 cents of premium on that. And while that may not seem like a ton, what's great about it is the 3.5 strike doesn't require a ton of capital, right? You're getting an 11-cent return on a $3.39 at-risk amount. And I get this number from subtracting 11 cents, the premium we received, because we're going to get that no matter what, minus the strike. So the actual amount you have at risk is $3.39. And 11 cents divided by $3.39, that's a 3.2% return on your amount at risk. And I believe that trade lasted 3 days. So 3.2% in 3 days off a trade that at that 3.5 level was never really in too much danger. And again, you really want to be comfortable when you try to take some of these trades on with the concept of assignment, because you could have maybe panicked a bit with this red candle when it got back down here to 388 on that Tuesday morning. Or I believe this was Wednesday morning, excuse me. Because I think the price of these got up to like 14, 15, maybe started pushing 20 at one point. But you have to set your level, get in, and just wait. We knew that our max profit point was 3.50. It was caught between saying 5 and 50, so that was Fav was what came out. Nice job, me. But we know that our max profit point is 3.50, and we know that further our break-even price is 3.39. So not only do we have cushion above here, we really have cushion all the way down to kind of here at this level. So until those levels are touched, there's really no need to panic. A lot of your risk maybe is overnight headline based, but this one was never really in trouble. A really nice in and out, and another great IV reversion type trade, similar to what we did the week before on the other side with the 4.5 strike calls for AMC, and a couple of weeks ago with the GameStop 18.5 calls. And if you want further information about those trades, and I pop over, let's go. This is probably the better way to show this. We have a new video about profiting off that type of volatility, right? That type of trade that we talk about where we look at implied volatility, there's a big candle, we see an increase in implied volatility and it coming back down. We've got it's I think 6-7-ish minutes. Could be worth the time if you're interested in hearing a little bit more about those types of trades. But without further ado, let's keep moving. DWAC. This is one that probably is the last one we really need to talk about for this week. But a big fan of the way that this sets up. Off the bat, we lost $265, so it didn't work off the bat, but I am so confident in this one. Not confident enough to start with the full size position. We still always want to start with the half size position, no matter how much we love the trade. Because again, no matter how much we love the trade, it can still move against us like we saw last week. But with that said, this is a really nice setup, and it's a very interesting numbers game. This one might even be worth a video on its own. But let's talk a little bit about it. DWAC, what is it? It's a SPAC. It's the one that's rumored to be merging with Truth Social, which is that Donald Trump related social media platform. And we got a question in the YouTube chat. How much do we pay in commissions per trade? We pay 40 cents in commission per trade. So that question may be leading into why this number is so small. And frankly, it probably is because I didn't update that at the end of last week. Typically, it's like $60, $70-ish dollars. A couple weeks ago, we really had a low amount of activity, but this probably does need to be adjusted upwards a hair. But yeah, 40 cents is the amount of commission we pay per trade. And more importantly, on our broker TD Ameritrade, any option we close for 5 cents or less, there's no commission on that trade and no commission on shares either. So it's kind of important in managing your commission, because if you do have a large commission fee structure from your broker, and you don't have some things like either lower commission or like, the benefit we have where trades under 5 cents are free, it can start to add up and ding your profits a little bit. Back to where we were, DWAC, the Truth Social type not Truth Social type. It is the Truth Social social media account. So, how do SPACs work? We know a lot about SPACs for those of you who have been following us for a long time. The most money we've ever lost on a trade was from a SPAC, so kind of by necessity, we have learned a lot about these since so that we don't make that same mistake again. But long story short, they can be incredibly volatile, as you saw when back in October of 2021, this thing went from 10 a share up to 175 when they found out who they were merging with. But at a high level, what's really, really important to understand about this, and is a huge part of the thesis behind this trade, is that it can't really go lower than 10. Because what is DWAC right now? It's not actually Truth Social. It's a SPAC. It's a blank check company. So they have X amount of dollars sitting in this company, which cumulatively equals about $10 a share. And it's just sitting as cash until it goes to shareholder vote, at which point they will undergo a reverse merger where they acquire some of Truth Social and then take them public through that reverse merger process, since Truth Social is private and DWAC is currently public. So that is how that works. It's kind of a roundabout way, avoiding the traditional IPO path for private companies to go public. Now, there's a lot of criticism with some of these SPACs because a lot of them are really, really garbage companies. RMO, here's an example. You've got this $10 floor, spikes up, comes back to 10. What's important to know is that, one, after the merger, all bets are off. It could shoot down below that $10 price floor. Is LIDR one? LIDR is one. Boom, 25 cents. It was chilling at that $10 price floor. Merger went through. See you later. So a lot of these are not great companies, but there is definitely some money to be made on the front end of this before the merger. And if for whatever reason it comes out that the merger vote's going to be next week, we get rid of this position, we pack our bags, we get out of there. But what's really, really cool about this is that if you start today, and we started last week, in fact, we got a really, really bad starting price on it. We started at 14.31. But so far, with the progress we've made so far, we have shares that we bought at 14.31. We sold covered calls for 49 cents. So our basis last week was 13.82. This week we sold covered calls and we closed those for 3 cents, so we could add 3 cents back in the interest of honesty and transparency. So we went into this week with a 13.85 basis in these shares. And then boom, we go hit these covered calls again and we get 46 cents of premium. So now we have these 500 shares with a basis of $13.39, despite the fact that we bought them less than a week ago for 14.31. So in that, 7-ish day span, we've dropped our break-even price by 92 cents. Think about that, 92 cents in about 2 weeks' time. That's pretty quick. And again, our break-even price is $13.39. So if we continue this progress of moving our break-even price down at this rate, the idea is we could weasel our break-even price down to 10 a share, which is the floor on this stock until the merger. And how risky is it? Is there going to be a merger coming up? How much time before this thing can go below 10? And the best way to figure that out is to go look at the option premiums, right? So if we take a look at June, which is 67 days away, that's like 7, 8, 9, 10 weeks away from now. The 10 strike puts have 3 cents of premium. So what the market is basically telling you right now is that there's basically no chance that the merger goes through between now and June. So we know that in 2 weeks, we lowered our break-even price by 92 cents. We have 10 weeks until these, 10 weeks until this, right? I think we are back. I think we're back online. Let me check my phone. This is really bad air. OBS just went down for me for whatever reason, which is the streaming software. But let me double check on this to make sure we're back online and good to go. Or if you can give me some confirmation in the chat that we're good to go, let me know if you guys can see, hear me. For those of you watching the replay right now, apologies. This is probably terrible air footage, streaming, etc. But let me check my phone, checking the channel on Twitch, and I think we're back up. Boom. Thank you, Jeff, for the confirmation. We'll keep it rolling. But the idea is that I don't really know exactly where it cut off, but the idea is that over the last 2 weeks, we've lowered our break-even price. Nice. We're back. We're good. Love to hear it. The idea is that over the last 2 weeks, we've lowered our break-even price by 92 cents. Oops, hit the wrong key. By 92 cents. So we know we have at least 10 weeks before this thing could possibly go below 10 a share, as evidenced by the lack of put premium at 10 a share. And if you're really concerned about that, just buy 5 of these puts. It'll cost you $15 and will protect you dollar for dollar, cent for cent below 10. But with that said, we know that between now and June, we have 10 weeks. We've done this in 2 weeks. So if we kind of forecast that out, we have 5 more 2-week periods. It means we can lower our break-even price by $4.60 total, meaning that by June, our break-even price on this will be below 10 a share. So we could just sell covered calls until whenever, until they finally decide to put this thing up for a vote on a merger. And since we are in a half-size position, if it ever does get too far below our break-even price, and our break-even price now is $13.39, so we're okay. But if it ever does get too far below, we could, again, strangle it with some of these as well. So we could take that $13.39 break-even, subtract like 30 of it, 30 cents right off that, and all of a sudden we're down to like $13.10. You look into the following week, boom, you hit some covered calls for like 40 more cents. You just keep the line moving. So what are the big risks? The big risk here is that, the premium just runs out, volatility gets crushed. But even with that, with the stock that's typically this volatile, you're going to have some call premium. So it may not be 50 cents a week and we may not be able to continue that pace that we were looking at before, but I really think we're still going to see decent week-to-week premiums. And it looks like, even with 4 days till expiry now, this thing's 30 cents out of the money, you could still get 32 cents of premium on it. And if we wanted to get a little more conservative and sell something slightly in the money, boom, you get like 55 cents on that. So there are a lot of different ways that over the next few weeks we could take our break-even price on this down to $10 a share and get comfortably into a position where that trade can't lose. So yes, we do on paper have a $265 loss, but if it holds where it holds this week, we're going to make back a little bit of that and only be down $100, sell more covered calls for next week, again, and again. But that's the idea with that DWAC trade. I really like the idea as so long as there's no merger vote on the horizon. Moving down a little bit further, ASTS, this one kind of fell off the face of the earth. We actually talked a little bit about it last week during the stream. We said, hey, there were some bad earnings, but some of these bad earnings moves, they can kind of play out a few more days after that initial big dip, and that's exactly what we saw. Over the next 2 or 3 days, it continued downward. So instead of getting a little bit too antsy and coming in with the 5-strike put, we were able to let that earnings decrease kind of play out over the next few days, and we were able to enter with the 4.5-strike put. Now, we got out of these for 21 cents, so really it's only like a $40 profit, but the great part about this, we sell expiries that expire, but we could sell as many of these as we want to, right? So we rolled them into the next week, 414 expiry, same exact strike with 4.5. And as ASTS currently sits at that 448 price at close today, we're on pace to have these be worth 2 cents at expiry, in which case we'll make $330 on the week. Combine that with the 40, and all of a sudden you've got a quick in and out, which lasted like 7, 8, 9 days for almost $400 in profit. And that's the idea behind what we're doing, right? We're not trying to hit a home run. We say this every single week on the stream. We don't want one big trade to make or break our week. We want a combination of several smart, consistent, profitable trades that we could rely on and add up to a really nice return. So far this year, we're looking at like a 16K profit. We're just through Q1. We're at like almost 10% return. So we're going to keep with that. And the best part about this is that the market's had a great year, but we'll notice a lot of these returns aren't necessarily being driven too much by the market. For example, we got our return last week despite a flat market. There were instances in January where we actually were hurt a little bit by the market moving up. Some of these positions, we don't really get helped too much by massive green weeks. And why do we do that, right? You could say, oh, you underperformed a few weeks ago by 2.5%. It would have just been easier to buy and hold the S&P 500. The first point I would make is that we've been crushing the S&P 500, just doing what we're doing. The second point I would make is that when the market does decide to pull back, and we could go look in, boom, when the market does drop 4.5% in a week, this one we got hit pretty bad with some, unusually bad luck on a couple tickers. But even with that bad luck, we still outperformed by a greater amount than the bigger week set us back. So that's kind of the trade-off, right? The good weeks are never going to be that good, But the great part is the bad weeks are really, really going to be muted. As we could see in our year-to-date summary, 2 red months between February and March in the S&P 500, and we still made money over that period. So the idea is we're kind of running our own race a little bit. Yes, we're trying to get out of the volatility of the market. I would love if this pattern just continued until the end of the year. That would be fantastic for us. We're a little bit behind NASDAQ. We're gaining on the S&P 500. But we're good where we are. We know that a 10% return in one quarter isn't normal for an index, and we know that our return wasn't necessarily dependent on those indices. So if we continue to run our own race, do what we've been doing in the market, set ourselves up intelligently every single week, I think we're going to be able to continue this type of success regardless of where the market decides to move. So that is kind of the segue into how are we going to do that for this upcoming week? And the answer is this little list of trades right here. And again, we like to target 1% ROR in a week, and we are dead on that number right here. We are looking at a 0.99% return. And the great part about this is that we only have actually, I need to update this trade right here. This is going to be 5.36 times 1,000. We are only 28.84% fully cash secured. So that means we could take assignment of our entire portfolio 4 times and still basically have enough money to cover it. That is the kind of position we want to be in because as we talked about a little bit at the top of the stream, what is lurking for us on Wednesday? We have CPI coming in the market. And the market really over the last couple of years has only cared about interest rates, and CPI is that data point that the Fed is using to drive that rate hike decision. Now, I'm a little bit conflicted on whether or not I think, and since I'm giving a spiel, let's make this a little bit better. Let's go to the full screen. Potentially a little bit conflicted about whether or not the market is still going to value CPI as much as it once did. We can recall even just back to December of last year, I think there was a CPI number that was only slightly in excess of what was expected, yet the market had a really, really visceral reaction to it. Now we're nearing the end of the rate hike cycle, or so the Fed says. If you choose to believe that we are nearing the end of the rate hike cycle, I would personally be of the opinion that CPI probably isn't going to be as important. But what could really move the market is uncertainty and unpredictability. And if the CPI number comes in Wednesday, and departs from expectations in such a way that the Fed needs to change the messaging that they've already put out, whether that's, we're going to start pivoting and reducing rates sooner, or we need to hike rates harder and faster, that kind of uncertainty is not good for the market. But in general, the big takeaway here is that there is uncertainty. So if we go back to the old standard presentation, boom, look at that. I'm basically a streamer and an editor right now. Check that out. But if we go back here, we don't want to have that kind of volatility, that kind of uncertainty, because in the past, it's really been what has crushed us. We go to 2022, we go to the year-to-date summary, and these losing weeks would be in vain if we didn't remember why they happened. Some of these larger losing weeks, and I wish that I had it marked for purposes of this discussion, but some of the larger red numbers that we see are because of bad CPI numbers, which sent the market spiraling down. And yes, it's great, because let's think about it. If CPI goes our way, realistically, what's our upside in a week? The way that we have things set up right now, the most we could really come away with is like 18, 1900, $2,000. Not a home run, but a very successful week if we get that, because that is the goal that we set out for at the beginning of the week. So if CPI goes in our favor, boom, we're going to get that, which is, a little decent bit of upside. But the issue is, what if CPI moves against us? And I'm of the opinion that the potential downside for CPI moving against us really starts to outweigh the benefit in it moving for us. And some of these trades that we saw today, we made about $400 in the market today, as you can see right there. That's one of the smaller accounts I'm trading in, so the number was a little bit higher. But with that said, we've got a decent amount of profit we can already take. And if we want to start looking at some of these, like DPST, probably not a ton there, but Affirm. We sold this thing for 58. It's trading for 26. Do we want to take a stock which we already know is very volatile, like Affirm, into CPI? And, we're holding out for what, $125 extra here, when we could take about $160 of profit off the board. So ideally, I think we have a flat to green day in the market tomorrow, and then we start to exit some of these Affirm positions. Not really that profitable yet. Something like Peloton is starting to get to a similar position, but ASTS is absolutely in that kind of a position. But taking a couple of these off the board would definitely make me feel a little bit better about that. And not that I don't feel good about taking potentially all these in right now, because again, we're only 28.84% fully cash secured, and that's by design. But really, the less, the better. And I don't want to take positions off the board just to take positions off the board. But if there's an opportunity like with what we highlighted a second ago with the firm, I think it's the smart thing to do heading into that. I'm so much rather would be on the side of regret where, oh no, I wish I had held on to this. It would have made me more money, as opposed to, oh damn, I wish that I had unloaded these because now we've dug ourselves a hole that's going to take 2 or 3 weeks to get out of. The great part about the way that we've been setting ourselves up on a week-to-week basis is that the holes that we've been getting into aren't that big. We've had 3 losing weeks so far in the year, and we're in April. And that's on the heels of 2 losing months entirely in the market. We've only lost 3 individual weeks. 2 of those weeks, those combined losses, that $631 is basically what we made today. So the significance or the magnitude of those is really, really small. Now, one of them was very, very large. And this was unfortunate because, again, one of the situations where it took 1 to basically 3 weeks to come back from that. So that is what we want to avoid, this big drawdown. And yes, our strategy and our positioning works in such a way where when we do have these big red weeks, we want to scale in further and further and further and give ourselves a nice bounce. As you could see in the 3 weeks following that drawdown, or the 4 weeks following that, we made $6,000 back effectively. But really, we want to wait for the big red week to happen so we could then position ourselves to get in. And again, this one isn't the greatest example because we had some things move against us really, really hard that our portfolio was concentrated in. But the next time we do get a dip in the market, and there will be another dip in the market, despite the fact that sometimes stretches like this in the market can put you to sleep. If we pull up the S&P 500 and look at it over the last month or so, it's very easy to fall asleep at the wheel when you see stretches like this in the market. Volatility gets sucked out a little bit. It almost seems a little bit too easy to make money, right? Because even right now, we're on track for a 5th profitable week in a row on a stretch that would have us take home about $7,500. This is when the market is easy. When the market is difficult is when it starts to turn back around on us. This is what we need to be prepared for. So again, that trade-off between not necessarily making thousands and thousands of dollars every week is a trade-off from a risk management perspective so we can avoid, big red weeks like we have had in prior years when the market does decide to turn around. And again, it will happen again at some point. This is just the 1-year chart, and while 2022 was a very bearish year, there's nothing stopping the market from having a couple more big red candles, and we just need to be prepared for that. But with that said, what else do we have set up for next week? We've got a firm, which we talked about. DPST is a rollover from last week. We talked about that position as well. A lot of these are basically rollovers on a week-to-week basis. Shout out to Unity. This is basically the one position I feel we don't really ever need to talk about this one on a week-to-week basis because it's so consistently, like last week, $105, even though it moved against us. The week before, 225, 615 a couple weeks before that, small loss before that. Anytime you see U in here, typically it's a decent result, right? We've made almost $1,000, I think, on it on the year, just with some very low stress ins and outs. And I don't even think we've had to double down on it. That one's been so great to us. But again, we're in on that one. 29 strike, 45 cents of premium means that we're sitting on a 28.55 break-even price there. UVXY, SPXU, these again are our hedges at their current levels. That bring us $285. That number is going to get a little bit higher if the markets start to turn against us on Wednesday. And then laser. This is one that, we're sitting at 28.84%. That's low. I want to keep it low because of CPI on Wednesday and be someone who reacts to the market instead of trying to guess and get in front of it. But I did add laser today, and there are a few really great things about this one. So let's pull the chart up here and talk about why this trade was so attractive to me. The first is what you could already see charted on here is this red line of support. It kind of lines up with where these candles bottomed out when this thing bottomed out last summer, back into June, early July of 2022. It stayed above those levels until briefly at the back end of 2022, end of December, early January 23. went under and then bounced back up. And again, you see another bounce near that level, and now we finally reach back down to that level. From a 1 year RSI perspective, what we're looking at is 34.73. That is oversold. It's not quite into the blue yet, but you're also seeing a combination of this low RSI with a little bit of an uplift in implied volatility. And those two alone, we could find probably a decent amount of opportunities that look like that. So I wasn't quite sold. But what I thought was very, very interesting with Laser, and really is what drove me to sell these puts, is what we see in the volume category right here. And I'm always kind of wary. Here we go, another speech. Let's go to the full screen. I'm always a little bit wary about option volume because you never really know why somebody is getting into a position. On the surface, buying a put is bearish, buying a call is bullish. But let's say you have a ton of shares of a stock and you're worried about a volatile event like CPI and you want to hedge them. What would you do? You would buy puts. That's why these things exist. These options exist to hedge positions. Trading of options is kind of a byproduct of how they work, but from their genesis, that is the reason why option contracts exist. So somebody buying puts, if they have a large bullish position, could just be a hedge and could be somebody who's bullish on a stock. So you really don't know. And that's why I don't think there's a lot of interesting stuff from those option flow services. A lot of those are like, oh, we saw big volume on this before this happened. If you look enough in the market, there's big volume everywhere. So they kind of pick and choose and are very social media forward about which ones selectively work. That's my spiel on that. Anyways, back to these numbers and why I want to throw out everything I just said and say why I think this is a little bit more interesting. So what we see here is an insane amount of puts being traded. Now, we don't know if these have been purchased yet. We don't know if these have been sold yet. We don't really know what's going on, but there is a massive, massive discrepancy here. And if you go to the scan, it may still be up from earlier. Never mind, I restarted my computer. But if you take a look at our high ROR puts without earnings scan, and you go to your settings, you go to customize, and then you put the put to call ratio in here, what you're going to see is that this has the highest put to call ratio of anything that's coming up in the 235 different stocks that are coming up in our scan. 14.67. So someone's maybe very bearish, you never know. But if we go to the option statistics, we're going to see something very, very interesting. And we're going to see that 98% of these puts are traded at the bid or below. And just to kind of give some context to this discussion, if you look at UAA, Under Armour, this is the next one on there, and you go to its option statistics, what you'll see, 11% are traded at the bid or below. So that's different. There's a little bit of a distribution between these. But let's go back to Laser. And what you'll see, as I finally get to the point here, is 98% of these are traded at the bid or below. So what does that mean? It means that they were put sales. Someone was selling puts. In a vacuum, this is a bullish trade. And typically, you don't sell puts to hedge a position. You don't sell options. You could sell calls to hedge a position, but you really typically don't sell puts. That's kind of the one trade in the market that you'll see people use to try to initiate a position. So we were comfortable that this large amount, 80,000 of these puts that were traded today, were sold bullishly. So that's a very interesting trend to me. The ratio is really, really large. Again, to emphasize that, 14.67, that's massive compared to all of these where you see them, kind of hovering around 1, not really deviating too far from that 14.67. Very, very large put to call ratio. But that is kind of the third and final thing aside from the combination of low RSI, support level coming into focus here, and then these, what I presume are bullish put sales. That's really kind of what put me over the edge and made me want to open this position in Laser, despite the fact that, CPI is coming up. I'm okay putting 2.81% of my account into this kind of a position. Worst comes to worst, we get shares at 536. From a chart perspective, that looks pretty good. We just keep the thing rolling week over week over week. But again, that's a half-size position. We always want to have plan B, that double down in our back pocket. But that was one interesting thing that I saw at the end of the day that I wanted to point out, that really high put sale volume. So that's what we've got top to bottom. And we have only really been streaming for about 45 minutes. I finally have gotten my spiel in of the recap and the preview for what we're currently holding. So what I want to do now is kind of jump into what, maybe some potential research here. Good time if you're watching, have any questions, you're like, hey, how does this work? If you have a stock that you want to talk about, throw it in the chat. We could happily take a look at. But what I primarily want to do here is game plan, because we know that we have this light portfolio and we want to react to the market on Wednesday. But we're really not going to be able to react to the market on Wednesday if we don't have a plan. We can't just wake up Wednesday morning, see that the market is red and start shooting from the hip. We want to have an intelligent, well-informed, well-educated plan of both bullish or bearish trades that we can get into. Because if the market runs up a bunch, I'm more than fine to take some bearish trades on and start playing the thing in the other direction. But if the market crashes, I need some names that I can potentially go bullish on. Great question from Petty Bourgeois in the Twitch chat. What do we think about the ticker AI? Lots of volatility and premium in an emerging industry. Let me put a bookmark in that because I think that's a very interesting discussion. There's a lot going on there. We talked about it a little bit in the Discord server. And I think that would be an interesting one to pull up the letter to the auditor from Carisdale Capital, the short seller who attacked it, and kind of dive into that one a little bit further. But let's quickly do a couple of scans. And furthering the, stream drop, some of the bad air, I'm going to run 2 seconds to grab a glass of water. I can see it. It is right behind me. This will be quick. Boom. Record time. Unfortunately, it's like a fourth of the way full. So I'm going to take what I get and we're going to keep it rolling. There you go. Some more good air for you. HT drinks water. So here we go. Boom. Options are casual scan, high ROR puts without earnings. We'll just kind of run through the process we run through intraday when we're trying to look for any sort of opportunity. And what we're going to see, a few of these jump off the page. And again, the big disclaimer with some of this scanning is that just because something is at the top of this list doesn't necessarily mean that it's a good investment idea. In fact, a vast majority of these at the top of this list are very bad investment ideas. But onward. DNMR. Do I know what that is? Absolutely not, but we can figure out together right now. Danimer Scientific Inc. Never heard of it. So we go to the analyze, we go to fundamentals, we go to DNMR. Boom. It's a materials company. It's a performance polymer company. The company is specializing in bioplastic replacements. Cool. I'm now comfortable it's not a healthcare stock at least, which is kind of 90% of the reason for that exercise. What we can do here really quickly, if I go back to the Discord, is we could do a little quick analysis using some in here and hourglass-trader.com if you would like to join this. Boom, another nice little segue. Big button right in the middle, trader.com. Boom. Dang, it didn't work. Boom, join Discord chat room. Big purple button right in the middle. That'll take you right back to what we are looking at right this second. You click the join button, boom, accept invite, and you'll be in. So anyways, we have these bots in here, so we can do a quick DD analyst, DNMR. Did I remember that correctly? Yeah, DNMR. What this is going to show us, hopefully, that's the fun of live streams. Boom. We've got some price targets, but look, we've got a 4.5 price target from October of 2022. This thing's trading at 4. In October of 2022, this thing was trading at, okay, 3-ish. So decent price target. They're on it. What does jump out is the fact that we have a low of about $2 a share. In a literal sense, the low is 157, but we see a little bit more of a base around 2. Let's keep an open mind. Yeah, these are some very, very high price targets from a couple of years ago. The other thing we could do here is, oh shoot, I think it's TA, and then you type in DNMR. How good is the memory? So good. Boom. And you get some really, really helpful ideas here and resistance points and some quick stats. And what this is going to help you do is just pick your strikes. Now, when you have a stock that's trading at $4 a share, these probably aren't far away enough from each other to be meaningful because I imagine this is, yeah, you've got a 2.5 strike option here, but really what we're looking at is, a dollar separated. So 4 is the pretty obvious strike that you would want to go with here right at the money. Looks like you could probably get like 35, 40-ish cents of premium on this thing, which would take your break even down to 360. Not horrible. I mean, I hate that I'm almost talking myself into this, but look, at the end of the day, this thing on March 23rd was trading at $2 a share. That's less than a month ago. That's a 50% drop from where it currently is. Maybe a decent one to keep on the watch list, but the way that it currently sits right now, this really isn't something that seems like too great of an idea. So don't go for the little carrot in front of the horse right here, the 11.11% ROR, because that could be a much, much larger LOSS. How about that? Back to the scan, Boyle. We know this is like a natural gas, energy-ish ETF. Not interested in playing anything like that. AMC, we all know about that one. DPST, already in it. CEI, that was a fun one. I remember that one from, Zach Morris on Twitter and his little group of scammers as they tried to pile a bunch of poor people into that one. And unfortunately, some people got by that one. But again, nothing really crazy jumping off the top here. There's some larger premium names, but what we really want to get at when we do these scans is, the reason that we liked lasers so much is that we saw this convergence of support, getting oversold with nice premium. So how do we whittle this down to give us some of those setups? The answer, you go to Intersect, you go to Personal, and then you go to HT Oversold Stocks, which you could find on our website as well if you're an HT Premium member. Here we go. So what we're going to see here is it really whittles it down to, and if I do just stocks here, it's probably easier to see. We go from 6 results to maybe still 6. I think it might still be 6 results. 5. There we go. There's one duplicate. Look at that. So Canopy Growth Corporation, CGC. Boom. We pull it on 23.47. That is massively low. This is one of those marijuana stocks. I remember this because we've traded this one a few times. And on a 3-year basis, this is far and away below any price that I've seen it on. It has made its way off of my watch lists for good reason. But with the 23.47 RSI hitting a 150 level, which I presume there's some premium at. Oh, the hands in frame, the hands are in frame. I don't know. This one looks kind of interesting. Now, what's tough about these when you have one of these is, one, you're really going to need to get that 3-cent fill. Because if you really want to sell these, and if you get that 3-cent fill, I mean, you have to sell like 200 of these. Okay, that's $600. That's maybe a little steep. But if you wanted to sell 100 of these and get $300, there's $55 of commission coming out of this. So effectively, your 3-cent fill is like a 2.5-cent fill. So that's pretty important. And then you would have those shares. And, if we did 100 of these, that's $14,000 worth of it. That's a lot. So maybe if we went down to like 50 or something, you're probably just looking at me right now like, HT, like, what are you doing, man? But you can make 150 max profit on a 147 break even with a $7,000 position size. That's just, you're really not even getting 150 either. You're really getting 122. Your broker's going to love that trade. But it's interesting, right? Because if we go to the 20-day chart, that 147 would be your break even. And while this thing definitely is trending like this, boom. See if I can match that slope with my hand. Nailed it. It seems like it might get there. I'd maybe wait for it to actually hit 150 because, those psychological barriers, those nice round numbers. Yeah, I mean, that's a great point. I think I agree a ton with that. Petty Bourgeois is like, this thing just keeps going down. I mean, look at that from, what is this? The beginning of February? Yeah, I mean, find me a decent green candle. Find me a positive day for the CGC investors over this stretch of time. I can't find you one. So maybe we'll ignore that one. But again, another example of, something that had an RSI so low that it was tempting and had a decent enough return to find itself on that list. FRC, First Republic, we already have exposure to that through the fourth name on this list, DPST. So I'm going to ignore both of those. AVXL, Anavex Life Sciences, it's in the name, Life Sciences. I don't think I really want anything to do with that unless news has already come out and this is a reaction to the news, so we'll at least look at it. AVXL, and that doesn't really seem to be the case. Looks like they're set to present at a virtual healthcare conference. There's some bank that has a price target of $50 a share. Good luck to that bank. We've got a $28 price target. There could be some action here. It's coming back down to 7. What are we looking at here? This is, again, me convincing myself to do something very stupid. Now, volume's low, spreads are wide, risk seems high with the presentation coming up. We've seen it has a propensity to have these large candles. Petty Bourgeois Bank is coming in with a 100K price target down in the bottom right. Watch out. So you will probably not see that name on the street much longer after that kind of a prediction. But this thing has a propensity to have these big red candles, and really that's the reason we try to avoid biotech, life sciences, etc. in the first place, right? We can handle a lot of this with what we do with our strategy. Quite frankly, we don't have a good way to handle this. In life sciences, biotech, that area is far more susceptible to those kind of moves than anywhere else. So that takes us to the final one, which is STEM Inc. And, the name STEM, I'm not entirely confident that this isn't going to be something very similar. STEM Inc. down at 5, 29.00. I mean, a really nice RSI. We zoom this thing out here. It's never been this low before, but what we're seeing is this a $10 price floor? Pull the mic up here. Is this a SPAC? Is this a SPAC? But high level, what we're going to see, 3.63% ROR right at 5. If you can get a 20-cent fill on that, that's going to take you down to 480. 480, you know what? Not phenomenal. Because even if you look at it on a 10-day basis, 480 is only down here. This thing just last week was trading at 466. That's just nowhere near enough premium, especially with 4 days left in the week. This is not going to get me what I want. That's not enough premium to take on that risk. But out of curiosity, I do kind of want to see what this one is. Industrials. It's a digitally connected intelligent energy storage network provider. Boom. I'm not going to read the whole thing because that'll probably put some of you to sleep. Although 10 o'clock on the East Coast right now, if anyone needs a little bedtime reading, there you go. It's right there. It's the description of STEM Inc. But what I'm really wary of is the fact that I think this might be a SPAC. And it looks like they had I don't know when they had their merger, but at least back at the end of 2020, they were still a blank check company. So if we go all the way down here, let's see. I don't see anything in the news feed, but quickly some more good air for you. On my second window, I'm going to search STEM stock SPAC. We'll see what we can see here. Boom. Nailed it. In late 2020, it would merge with a special purpose acquisition company. So it is a former SPAC, which, isn't inherently the worst thing in the world, but more often than not, it's pretty bad. One SPAC that's doing well, DraftKings was a former SPAC, but that was done in a much better way. That transaction was done really before the SPAC boom, when all these garbage companies stopped, or when all these garbage companies started trying to get in on the SPAC boom. But I'm going to just stay away from that one. I've been burned before. PGY was at that level, I think, when we tried to take a bite out of it. So leaving that one alone. So really, no fruit has been born from this little search right here. But the good thing about this is if Wednesday the market does go down the way that we thought it potentially might, then this is going to have a lot more names on this list. And we have another one as well, like oversold, because this picks up anything under 30. This picks up anything under 40 to get you stuff that's like close, right? So we have here is URI, United Rentals, Zim, UVIX. So that's volatility. This is a stock that just paid out a dividend, so that's affecting that. Now URI, interesting. A few big red candles. 3-year basis, really no super strong support to point to. I mean, this level right here is maybe something I could see because you've got a few peaks. You've got a few peaks and it leveled here. As you can see, that's kind of where the red candle stopped, this, 365, 360-ish level. But again, what's tough about these when they're trading for $364 a share is if you want to sell just one cash secured put on that, it's going to take you like $36,000 fully cash secured. So potentially a spread might be a little bit better of a way to play that. There's plenty of premium at and around the money. You can go to 357.5 and get 1% right there. If we look at this on like a 20-day basis, what does 357 look like? Not great because it was just down to 345. Something's probably up with the stock here. Economic slowdown following ADP data. Interesting. Underperform. Yeah, anytime you see like a lot of stocks like we saw earlier with STEM, like banks will just be throwing out whatever optimistic price targets. And, you don't have to put too much stock into them. What I do put stock into is when you get downgrades. A lot of downgrades are kind of not death sentences, but definitely not alive sentences, if that's a concept. We're an hour in here. I'm just saying whatever, I guess. But yeah, not a big fan of that. Zim, we already talked about that. Now let's go the other way, right? If the market shoots up, what are some stocks that are already overbought right now, which we could potentially play bearishly? So for that, we go to the overbought stock scanner. And boom, we have 2 stocks, Lululemon Athletica, and this is a gold ETF. So let's take a peek. What's going on with Lulu? Lulu is at 363.37. We take the news away, and we're going to see that that's largely because of this massive gap up after earnings. And if we look at the 1-year chart, boom, it's still overbought from an RSI perspective. Better time to get in, obviously, would have been after that massive gap up. Well, we see some good things here on this chart. First, we got some pretty, established resistance here from the beginning of December 2022, and that's going to be right about this 390 level. We already have some evidence that it's leveling off a little bit. There's no earnings really on the horizon for a while, at least for another quarter. And presumably there's nice premium on it, which is why it's showing up on this scan. So what we could do, we know that this thing has 390 resistance. On a shorter term, probably 380-ish resistance. But when you go to the option chain, there's really not a lot there. But the idea here is that if the market starts shooting up a bunch on Wednesday due to CPI, some of these higher strikes are going to start to have a little bit of premium. So I don't think there's really anything here right now, but I think there could be down the road. But just potentially keep an eye on that one. And then Nugget is a gold ETF. If we take a look at this one, just been flying, it looks like, on a 1-year basis. Boom, we've got... This is a 2x leveraged ETF, so the ideas of support and resistance aren't really going to be as much of a thing as for a typical stock. But I do still love the idea of RSI. It was much more overbought before, and as you can see, it's fallen back down from 48. So you've already started to get a little bit of that move, especially after it already dropped 2.47% today. So probably not the greatest entry from a bearish perspective. You maybe could get back in on like a 47 or a 48, which would give you a break-even price in the 48, 49-ish range. Maybe not the worst thing in the world, but I just don't love the entry right there. And again, at the end of the day, these are all just kind of ideas. We've got the trades that we've got as we head into the week, which you can see right here. And if we do nothing and nothing happens, boom, we've got $1,900 in our pocket at the end of the week, and we run it back for another week. But with that said, these are ideas for if something happens on Wednesday with CPI, which you never know. It could happen, could not happen, but always good to have some of these things on your radar and some of these names that we've been talking about. One other intersection that might be interesting. Let's see. Profitable companies. How about this one? Value investing, baby. It's back. And here we go. We've got some of these, and every single stock on here has positive earnings. So that's the idea with that one. If we flip this to options, we're probably going to be able to sort by ROR a little bit better. But the idea here is that, if the market does decide to come back down, stocks that are making money are probably going to perform the best. Now, this isn't really to say anything about their PE ratio, that is. It's just to say that they have that E in the PE ratio. So you've got some of these. I don't FRC, it's making money, it's a bank, but we know there's a lot more going on there. Dish, we know there's a lot going on there as well with some of the business changes they've been trying to make and some of the potential hacks that I think they had lately. But just some more ideas to put in front of you. And we just talked about how that doesn't necessarily affect EPS. How about a PE ratio scan? Let's throw this thing in here. Boom. We've got Zim. We've got VLO, URI. And these are better values. So what's happening here is their PE ratio is under 20. And we picked that 20 amount because the average PE ratio of the S&P 500, I think, is currently like about 20. Let me do this again off the screen. I'll take a peek. Average PE ratio for the S&P 500. The current PE ratio, boom, 21.96. See? There you go. So that's why that's kind of our gauge as to what is a good value, quote unquote. So important to keep that in mind as well. But Zim, VLO, X, URI, all important things on here. Now, what you do potentially want to think about is just because the ratio is good doesn't mean that it's good. A lot of the time, what you'll see here, and the reason companies like this will have low PE ratios is because revenue is decreasing. So potentially something to keep in mind, right? The whole idea behind PE ratios and valuations is that they're multiples, right? So you take their earnings and, oh, I would pay earnings times X. The price to earnings ratio is technically the multiple you're paying on a stock. But those multiples are done, and the reason a multiple is paid is because of the expectation of greater forward earnings in the future. So if you have a stock with a really, really high PE ratio and all of a sudden sales or earnings start to flatten out a bit, all of a sudden people aren't necessarily going to want to pay as high of a multiple for potential growth because historical earnings are showing that that growth is slowing down a little bit. So that's the idea with the PE ratio and why some of these really, really highly valued stocks, which I'm going to show you right about now with NVIDIA. Come over here. Boom, you've got a PE ratio of 158.29 on NVIDIA. That's a massive, massive number. I think AMD has like 80s or 90s off the top of my head. 113, it's gotten worse. Boom. So these are a couple ones that I have my eye on because when the market starts to fall back, people start to pay a little bit more attention to fundamentals. It's easy to say, oh, fundamentals don't really matter in the market, but really what we've seen historically is that fundamentals are one of those things that matter, or one of those things that don't matter until they do. And when they do, you really want to make sure that you're on the right side of things with things like PE ratio of the stocks that you're invested in. Because when we make these bullish positions, plan B or C or D or whatever it is down the road is taking assignment of these shares at a certain price. So we need to be comfortable that at that certain price, that's a good level to potentially be in on something. And it's one of the reasons why a while ago we thought that Meta was a good investment because of right now, it's at 26.75. That's a little bit above what the S&P 500 is trading at. But like a year ago, it was like half price. It was at a PE ratio like in the teens, which is just when you got a stock that's profitable in the area that they're in, that it's almost free money for that one. Now, we never get too crazy with buying and holding and just letting things ride, but that was a pretty easy one to get in and out on. Google, another good example. It's run up a bunch. It's run up about 10%, so this used to be closer to 20, but it's at 23.47. You compare that to something like an Amazon, which has a PE ratio, doesn't right now, but it has one of like 80 or 90 the last time that they had positive earnings. You look at something like an Apple, and you start to get up there a little bit, 27.53. You go to another big tech name like Microsoft, and you're going to see a PE ratio of 32.17. Boom. Did those in ascending order. Remembered that properly. But that's the idea right there. So some of these names, while they may not be the sexiest names to invest in, if shit starts hitting the fan in the market, X may not be the worst thing in the world. But yeah, to the point that Petty Bourgeois made a second ago that I just rudely ignored because, I was rolling. I was on a spiel. I had it going. But getting back to that comment, they have run up a decent bit in the past few months. And, they've come from 18 to 25. They've been higher. They've been lower. We go to the 3-year chart. We'll probably get a little bit more insight here. And this is what's always kind of scared me about X. But commodity pricing is going up, right? It's one of those things where if inflation is persistent, that kind of stuff is here to stay. So
there's decent premium in the sense that you can get 1.46% basically dead at the money. That's 34 cents of premium. That sticks your break even price at like 25.66 ish. Boom, more mental math, which, is and isn't great. 25.66 is up here. This thing will have big red candles. It'll have big green candles. One of those stocks, though, where if you are a little bit patient and hang around for some of those big red candles, I think that's a better entry. Now, yes, it came up here. Yes, there's premium, but we want to be cognizant when we take a look at what's gone on in the past month, right? Just because something is a decent entry doesn't mean it's a good entry right this second. If the past is any indication, there will probably be some random day in the future where we see another red candle, and it may go up to 27, 28 before dropping back down to 26, but we don't want to be adding into strength, if that makes sense. We want to scale into weakness with the going to turn around into strength. Zach, shout out for the follow. Thank you for hitting up the Twitch chat. And honestly, the noise that made kind of scared the hell out of me because I have not heard it all night. But keeping the line moving here. What else we got? Zim, this is a shipping one. We talked about declining revenues. The price of shipping containers has been decreasing steadily. Let me see if I could just quickly pull up a price of shipping container chart here. This isn't going very well. Live stream. Here we go. Can't find a chart to back it up, but if I find one, I'll share it in the Discord. But generally speaking, the reason this thing ran up so high is because the price of shipping ran up so high. It's a shipping company. And that kind of dictates the revenue and profit that they're making. And then it fell back down because the price of those have come back down. Zach, doing great. How are you doing on the Monday night? Appreciate you tuning in and checking into the chat. That's kind of the end of what we've got here. Every now and then I get bored during the day and throw together some different kind of scans. Let's see what we're rocking with right here. We have profitable companies we've been through. We could maybe do, I don't want to do IV reversion. Where did I go to college? I went to Auburn University, the Harvard of the South, as no one calls it. And then I got a grad degree at the University of Georgia, and I think they're sitting over there. I need to put them on a wall or something, but I think it's weird having your degrees up in your bedroom. So one of these days I'll have an office and get those things put up. Maybe maybe I should just put them above the bed. Would having the diplomas up there make me look smarter? Who knows? So let me take a peek here. Really nothing exciting going on in these scanners. One thing I potentially want to look at is if we go to personal. Let's see. IV rank. I should have an IV rank scanner, damn it. There it is. My mouse was right on it. So what we're looking at here, a lot of the time, what these scans are looking at is just implied volatility in general, because we know that implied volatility is going to drive option premium. So the idea, though, is, if a stock is always volatile, that means it's always going to have option premium. And sometimes from an option selling perspective, it's better to target the spikes in implied volatility so that as implied volatility increases, you're selling into that. And then when the implied volatility starts coming out of it predictably, the option premium is also coming out of the stock. So you benefit as a seller. But with that said, we've got this scan right here, which has given us 27 names where implied volatility is high right now, but it's also unusually high. It's going to bring back results where implied volatility is in the 70th to 100th percentile, meaning that of the last 256, or maybe 252, I forgot how many trading days there are in a year, but whatever that number is, out of those, where today's implied volatility ranks from a percentile. So Dish, a few of these off the bat, like Dish, Rigel, maybe that was poorly pronounced, we'll never know. Space, Virgin Galactic, ABR, and then Tupperware Brands. Tupperware Brands, one of the most reliable mainstays in the kitchen. Has an IV percentile of 100%, meaning that IV over the last calendar year is at an all-time high. So if we go to Dish, that's what you're going to see, right? And you're going to see another thing as well. You've got the intersection of the low RSI combined with the high implied volatility. And as this keeps creeping up, these options are going to look better and better from a premium perspective. So what we could actually do right here is there's 1% at 8, which is pretty crazy. If you take a look at like the 20-day chart here, 8 hasn't even been sniffed. But if you want to get a little bit smarter, potentially go with the half size position at 8.5 because, again, full size position at 8 is going to bring just as much money as a half size position at 8.5. And starting with the half size position at 8.5 is going to give you the benefit of having a little bit of flexibility with managing the position. We're up to 17 live viewers right now. It's unfortunate we're almost at the end of the stream, but one of these days, going back to the full cam, where is it? One of these days, we're going to get to 30 live and we're giving away one of these. So if you are watching tonight, we do this just about every week. So tune back in next time and you could be the proud owner of a newly focused on HT Yeti tumbler. Back to the standard presentation so we could keep the thing rolling. 8 point, yeah, there we go. Petty Bourgeois got the eye on the tumbler. I love it. I love it. And I'm drinking out of my very own right now because I ordered a lot of them. But with an 8.5 strike put, 2% ROR, you open that half size position, you get a 1% return. You know, you sell 5 of these things for 16 cents a piece. You're walking out the door with an $80 profit by the end of the week, provided the stock stays above 850. Not too bad right there. Now, what you really, I think, you know, these are great for weekly options and all, but I think what you really do want to target on these when you look at like a longer term trend where something is moving up this steeply. Oh, we were looking at the 180 day before. No wonder RSI is a little bit higher. But what you want to do when it's moving up this steeply is maybe not look at the 1 day or the 1 week, but maybe look a little bit longer term. And what we know is that in the 45 to 60 day to expiry window, those further out of the money options decay a little bit more rapidly. So what you potentially would want to do is look at something like a 5 strike put in June. Now this offers 9% ROR. And you might say, look, HT, I don't want to wait 67 days for 9% ROR. What I would say potentially as a counter to that is June 16th, 2023 is 10 days away. This is offering 9% return. That's a 9% return in 10 weeks is almost 1% a week. The other thing that I will say is that if we're looking at this trend of implied volatility moving upwards and the stock coming down, if it rebounds and kills implied volatility, the option premium here is going to get slammed. So if you could take even just half or 50% of max profit in a few weeks, that turns into 4 or 5% ROR in 3 or 4 weeks, and you're actually above that. So potentially taking a look at taking a bite out of this, selling 10 of these. One great part is that it doesn't take very much buying power. It only takes up $500 of buying power. And so you're looking at a $410 profit on $500 of buying power. That's an 80% return on capital, but we don't want to look at it that way because we want to be as conservative as possible. You're looking at a decent amount here, and I don't hate the idea of potentially selling some 5 strike puts on Dish headed into June. Those are decently far out of the money. You've got a break-even price. Let's pull up the old handy-dandy system calculator. If you get that 41-cent premium, 5 strike minus 0.41, that's going to get you a 4.59 basis, which is $4.27 away from 886. And 427 divided by 8.86 means the stock is going to have to drop 48% between now and June for that trade to lose a single cent. So that's kind of the idea with that. Now, what is a little bit tougher is a lot of the time, these things really can drop down hard. Some of the biggest losses that we actually had last year were relating to these longer dated options. However, when you're at a 5 strike, can things get lower? Yes. But in a literal sense, this thing could go to 0 and we'd lose $4,500. If it happens, that would be insanely quick for it to happen and would be insanely unlucky, but it wouldn't ruin us. We'll remember in the first month of 2022, we lost like 40 grand because we did this at a much higher level with a much larger position size. So this is maybe a little bit more watered down of a way to play that kind of safely. So, and again, you don't want to take this thing to expiry. You really aim to have that bounce driven by RSI along with that decrease in implied volatility. We've seen a little bit of the bounce because it has come up from 850s. And one thing we can potentially do here is take a look at the chart here itself. So what we see if we go to a 20-day chart, These things got up to like, 40, 50-ish cents a piece. But before, they've been hanging out in this 30-cent range around here. And theoretically, the option's going up in price, implied volatility is continuing into it. Once it comes out, this will start to come back down a little bit, even just into the mid 20s. That gets you a third of that profit. So I think that's an interesting idea. And if we go back to this scanner, we could look at something like Virgin Galactic, SPCE. You're probably going to have a very similar setup here. It's jumped up a ton. This is a 20-day, not a ton. That was wrong. On a 1-year basis, this thing's at 34.34. Implied volatility at a 1-year high. This thing's kind of at support in the sense it's near 350-ish, but we know that the low is 298. So if you wanted to enter into something bullish, this probably isn't the best time to do it after it's already bounced 50 cents. But a similar trade here would have to look like July. You get 10% at a 2 strike. It kind of gets to slim pickings on this one. Not a big fan of that. We'll look at one more of these for fun. Let's look at Tupper. Let's look at ABR. Never mind, that's a realty trust. This is a pharmaceutical company. Tisk. Let's look at Tupperware. Yeah, TUP. It's a lower price on the stock, but you've got July expiry. You've got a 1 strike. It's down 48% today. I don't know what on earth happened to Tupperware, but yikes, that does not look promising. Tupperware stock creators after food storage company warns it may go bust. Well, this is a great segue into another point about these longer dated trades. If there's any inkling that a company may go, into bankruptcy, if there's a going concern risk, that's really, really bad, actually. That's something issued potentially by an auditor. I don't know if they internally issued that or what, but a going concern risk is not good. It means that the company is at risk of going under. So don't do that one. There you go. Yeah, and that's about it. So, we looked at some of the overbought. We looked at some of the oversold. Here's what we've got. We've been going for an hour and a half-ish at this point. Probably a good time to cut it off. I got to run. But this is what we got. And if the market neither goes up nor goes down, which is unlikely with CPI Wednesday, but you never know, we're going to take home about a 1% return on risk. And again, we're only 28.84% fully cash secured. I cannot emphasize that point enough. There really is not a ton of risk being had on our side. So really, no matter what happens, ideally we get out of a lot of positions tomorrow afternoon and go into CPI with as little as possible. But if we're not able to do that, we're still in a very small portfolio. So there you have it. Back to camera one. For those of you who have made it to the end of the stream, thanks again for tuning in on the Monday night Easter adjusted, maybe Passover adjusted. They were both this weekend. But spring, April holiday adjusted weekly stream. Rolls off the tongue, right? But we've got a really good week lined up. I think we've got a good plan. We saw some good things on the scanner. If you want to join and talk with us during the week, because I think we're going to be reacting a lot to what happens Wednesday and you want to trade with us, www.hourglass-trader.com. You're going to have that big purple button in the middle to join our Discord server. Perfectly free to join. For those of you who have been joining us on a weekly basis in here, just like Jeff, who tuned into the YouTube and just said thank you for the stream. Jeff, thank you for watching every single week. Jules, good night. Petty Bourgeois, you may or may not still be there, but appreciate you being active in the chat as well. And to all the new followers, thank you for joining tonight. We hope that you'll join us for multiple more in the future. But been a great year so far. We're going to continue to run our own race. We're beating the S&P 500. We're slightly underperforming NASDAQ. We don't want to worry about that because those two indices are on pace for a year that, quite frankly, I don't know if they've ever had. So focus on running our own race, and we're going to reap the benefits of that sooner rather than later, hopefully. But until next time, cheesy sign off. This has been the Hourglass Trader, where as time passes, we make money, and hopefully we see you guys again same time next week with a little bit more money in our accounts than we have right this second. So that's all we got. Thanks, guys.